Pensions are a fairly recent phenomenon. Actually, if you look at it from a European point of view, the first formal pension systems were only really put together at the end of the 19th century. In fact, Otto von Bismarck is very often credited with that. And he had a very peculiar approach to that, which goes with the kind of conservative patriarch view that you can earn your retirement if you work. So it also works on the premise that you have to save up for your own retirement. So essentially, it's what we nowadays call a capital-funded regime, where you have your own pension pot. Now, that initial experiment sort of went through a rather movemented period. First of all, the experiences are that it takes a long while for it to get going, a capital-funded system, and also a long time to become sustainable. And secondly, as really sort of Germany has seen through two world wars and the Great Depression of the 1930s, it is very vulnerable to political and economic upheaval. And many people have made that experience of effectively having lost not only sort of what they thought they owned at the time, but also the entitlements of what they hoped they could retire on in the future. Which brings us to Beveridge, which is often sort of considered the equivalent post-war model, where at the end of the day, a more humanist approach is being taken, and the central idea is prevent old age poverty and use tax funds for that purpose. More flexible to implement because it comes from current tax income, but as we find out today, in particular, very vulnerable to demographic and economic deceleration. So, in a nutshell, whereas for one you need stability, for the other you need growth. Nowadays, we tend to look at pension systems sort of under the guise of pillars. So we've got three pillars, and they represent more or less the triangulation of the state, the employer, and of the individual. So pillar one basically being the state-funded, usually pay-as-you-go pension. The second, an occupational pension being provided by the employer. The third, individual savings, but supported by and subsidized by the state. What is not shown here, but you see four pillars on your right, is what we call the pillar zero, which becomes increasingly more important. One would say, perhaps, unfortunately, from the perspective of somebody who's relying on modern welfare state economics, because the pillar zero is effectively the informal networks and informal wealth that people have access to, which, as we all know, is not always very evenly distributed. The challenges we're facing nowadays are manifold, and I'm just going to go through them very rapidly. On the one hand, we have challenges on the demographic side. We've got a declining population in Europe. Life expectancy is increasing, which means people draw a pension for much longer. We have issues regarding the labor market, globalization being effectively one sort of big theme that has in some areas created structural unemployment, cyclical unemployment, not least in the aftermath of the great financial crisis of 2008-2009. And then also technological innovation, which is, some consider, a real threat to a large part of the labor market going forward. Inequality, as I mentioned before, access to employment, and therefore equality of the opportunity to generate income, and inequality of wealth. Finally, public finances are under stress, and we know that. And that means the fiscal capacity to compensate for shortcomings from these other sources, to compensate shocks, and to provide social security. So the impact of all of these we can map on two axes. On the one hand, the socio-economic axis, which means the social contract as we know it, the vertical contract between different strata of society, redistribution, which is also a part of social security and therefore also the pension system, and the intergenerational contract, the contract between in-work and retirees. And the financial side of things. Liquidity, on the one hand, who pays for today's retirees under a pay-as-you-go? And solvency. Do we have enough of a capital stock today to fund pensions in the future? On the demographic side of things, one very often quoted statistic, and one that I'm not going to belabor much. But by most forecasts, the European working age population is going to shrink by some 10% by 2080. This has a number of reasons. One is the fertility rate, which is at the moment at 1.6 and not getting better. And on the other hand, longevity. People's life expectancy is increasing, is getting better, already stands at 78 years for men, 83 for women, and it is going to increase. And people say, most forecasts will tell you that we expect to add another 4 years over the next 40 to 50 year period, which has the effect that by 2080, about 1 in 3 people will be aged 65 or older. That means that the ratio of people in working age vis-à-vis people in retirement, or people deemed at a retirement age, and we'll come to that in a minute, will drop from currently 4:1 to 2:1. Already today, replacement rates, which is what you can expect to receive as a retirement income in percent of the average income you had during your working days, stands at about 70%, according to OECD numbers. So 70% of the average working life income. Now that masks very, very significant differences, and you can see them on this bar chart here. On the one hand, in several countries, you have replacement rates which range more in the 40 to 50% scale. Secondly, the composition of the replacement, and this is very, very critical, of course, for the sustainability of your pension, differs as well. The dark bars are what the OECD would term mandatory pensions, which includes the state pension, usually a pay-as-you-go pension, and the mandatory, obligatory part of the occupational pension. So the employer is by law forced to offer pensions to his employees. Now, in several countries, you see these light bars making up very significant parts of the overall replacement. And there are very few. They're effectively the UK, Ireland, and already with some question marks, Germany and Belgium. This effectively is the personal pension side of things, where people save individually for retirement. And we'll come to that when we talk about the Pillar 3 and what a Pillar 3 can add over and above the mandatory statutory pension scheme. However, I think what is important to bear in mind is, with a view to the demographic trends, the replacement rates will decline by about 10% over the next 40 years. So if today we're at 70% on average, we're moving to 60. If you are in the lower end of this continuum and you are at 50, you will retire on 40% of the average income. The capacity of the public sector to make up for these shortfalls is also very constrained. and I'm not going to lose much time on this, but you are all quite aware of the fact that most of the European countries already are running relatively high public debts, are running relatively constant deficits. And the possibility for them to redistribute or to plug holes is limited. Already about 40% on average of the public expenditure in the EU goes towards social security, and effectively 10% of the total public expenditure, so a quarter of all social security goes towards pension, and that share is bound to increase further. Very importantly here, the labor market. Demographics is one thing, so how many people are there in working age? But the more important, almost, the more important question is, will people who are at working age actually have employment? And we have sort of drawn on some quite interesting work that has been done recently on the impact of technological innovation and on the capability of artificial intelligence, of robotics, of sort of most of the IT-inspired innovation to displace human labor. And although it is always very difficult to predict the future, particularly if it's forward-looking, as Niels Bohr was saying, there is now an increasing wealth of research that points to the fact that significant amounts of jobs could be at risk over the course of the next 20 to 30 years. There are some studies which at the time sort of sort of caused a lot of upheaval by Oxford University, effectively claiming that about 50% of American jobs could be at risk. There are other studies that sort of are more moderate on that outlook. The question is, of course, how rapidly is the labor market going to adjust? Will it generate new jobs, and will it enable people to acquire new skills to qualify for these new jobs at a pace that is commensurate to the amount of substitution that's taking place? So there are many imponderables here, but we believe that all in all, the impact over the next 30 years is likely to be momentous, and we are capturing that with this image of the chessboard. The point being that many people argue, in particular researchers from the MIT have sort of used this very, very nicely. Many people argue that we are nearing the second half of the chessboard now, where technological change and its impact on the labor market is going to accelerate exponentially, as the way the rice grains on the chessboard are going to accelerate when you enter the second half. So, policy implications across the board for all of the three pillars of the pension system. In a nutshell, Pillar 1 policy options that have to do with increasing contributions, that have to do with increasing entitlements, with decreasing entitlements, that have to do with lengthening the working life. These are already underway. These are being dealt with. Pillar 2 and Pillar 3 policy options also, they are being looked at. Many policy options are looking at increasing the role of the Pillar 2 and Pillar 3 within the whole framework, but there are limits to that. There are limits, first of all, as I mentioned before, in terms of the continuity, the availability and the continuity of employment. Secondly, the mobility of the labor force, which is also shortening the continuity of employment. The administration of entitlements, because smaller companies find it difficult to administer pension schemes of their own, which limits the Pillar 2. And finally, prudential requirements. That was clear. That was a clear reminder. On which note, I'm going to speed up. So in terms of the general observations, we come to the conclusion that there is a variety of policy options that need to be entertained. First of all, diversification of pension schemes. The reliance on Pillar 1 needs to be reduced. There is a stronger role for Pillar 2 and Pillar 3. And so that basically goes to strengthening the capital funded component, which is mostly the Pillar 2 and 3. But we also need to look beyond that at broader options. So I'm going to just pick out two elements here. Pillar 3 and the PEPP. We have heard that there is a new initiative on the part of the European Union to promote Pillar 3, to promote personal pension plans. The details of that, unfortunately, will not be unveiled today, but in the course of the week. But we have, I would say, expectations. We have a general positive view of the project, but we also have certain criteria that we would like to see realized in that project. It's got to be a simple product, a product that is a genuine retirement product, not just a repackaged savings product. It's got to be vesting at a statutory pension age. It's got to be geared towards alleviating longevity risk and sharing longevity risk. There have to be clear decision-making pathways which make this product transparent and which make the process of signing up to this product simple and safe for the investor. So there has to be a default option. That default option has to start from a very, very safe place. So it's got to be a safety first default option, which protects the investor capital and generates income, preferably in the form of an annuity. It's got to contain long-term investments, but exclude complex and opaque instruments. And it's got to be portable, and switching has to be possible. Finally, it's got to be transparent. There has to be comprehensive information in a standardized format, easy to understand, because all of the jargon associated with pensions, the jargon that effectively we've been going through here, is not something that the consumer should be exposed to. And finally, there should be clarity on fees, charges, and on the performance metrics of the proposed investment opportunity. The obstacles to taxation, to the PEPP are also quite clear. It is the multitude of taxation regimes. We understand that taxation is a major argument in the context of personal pensions. It is a major argument in increasing the take-up. So therefore, the cooperation of the member states in offering favorable pensions, favorable tax treatment for a PEPP is going to be critical for its success. And that is also something that EIOPA has very clearly advocated. And finally, the limitations need to be borne in mind. Pillar 3 is one element of the puzzle, but is not going to be in itself the solution. It is being able to invest in a personal pension is a question of disposable income, savings rates. And this is something that is not obvious in every member state and for every community within society. Now, the second bit of the forward-looking perspective, I would invite you to look at the bigger picture. We have looked at the Pillar 3, the smallest of the three pillars. Now I would like to invite you to look at the very big picture. Not only looking at the retirement income, but looking at income, looking at the potential for citizens to obtain that security which Beveridge intended for them in his basic model, a basic income. throughout working age and throughout retirement. It's a concept, and it would require a major rebuild of the welfare state. We're not saying at this stage that this is something that we would hand on heart and of today recommend. We would recommend, however, exploring these sorts of big picture opportunities, and we very much support the tests, the field tests, the experiments that are being carried out in some of the member states, in the Netherlands, Finland, for instance, to try and see whether these are viable perspectives for the future. So this is the second and the more ambitious leg of our way towards a sustainable and adequate pension system in Europe. Thank you so much.